Welcome to The Deep Dive, your shortcut to being well-informed. Today we're diving into Semtech Corporation's Q2 FY26 results. We've gone through the earnings call and all the related docs to pull out what really matters. Our mission, to get you totally up to speed on Semtech's performance and, where they might be headed.
That's right. Semtech's been going through a pretty big transformation, and these results give us a real glimpse into how those strategic shifts are actually working out. We'll connect the dots: financials, products, market trends, especially in semiconductors.
Okay, let's jump right in. The headlines for Semtech's Q2 FY26. They reported non-GAAP EPS of $0.41. That's a slight beat over the $1.40 in consensus. And revenue came in at a record $257.6 million, just edging out the $256.1 million expected. So, pretty solid.
Yeah, solid beats. But beyond those top numbers, the thing that really jumped out for me anyway was the leverage ratio. Their net leverage dropped from 8.8 times a year ago down to about 1.6 times this quarter. I mean, that's a huge reduction in debt. It really shows they've shored up their financial foundation, gives them flexibility.
Right, that is dramatic. How did the market take that news? Because the stock only ticked up, 0.6% after hours? Seems kind of muted.
Yeah, a bit muted. It suggests the beats and the guidance, which was basically in line. Well, they largely met expectations. No huge surprises, maybe. It paints a picture of, let's say, steady execution rather than a big positive shock.
Okay, steady execution. Let's dig into that execution then, deeper into the financials. They posted some pretty impressive margin expansion, didn't they? Non-GAAP gross margin hit 53.2%. That's up 280 basis points year over year. And the semiconductor part specifically was even stronger, 60.7%.
Absolutely. That's real efficiency showing through. And it flows down the line, too. Non-GAAP operating margin improved by 460 basis points year over year, hitting 18.8%. And crucially, look at the cash flow. Operating cash flow jumped to $44.4 million, free cash flow to $41.5 million, both way up sequentially. And they used that cash, too, paid down another $25 million on their term loan voluntarily in Q2.
That all sounds great on the non-GAAP side. But you hinted earlier the GAAP results showed a loss. Can you explain that? It's something we should be worried about.
Ah, right. Good question. So the GAAP EPS was a loss, 31 cents per share, but it was driven primarily by a non-cash charge, a $41.9 million goodwill impairment. It relates to their connected services business where basically internal forecasts weren't met. So it's an accounting thing, Important to separate that non-cash item from the underlying operational strength we just talked about. It doesn't really change that story.
Got it. So more of an accounting adjustment than an operational red flag. This leads us nicely to management. The CEO, Hong Ho, talked about his first year. 3 priorities: balance sheet, portfolio focus, and investment, and culture. How's that played out? What's next?
Well, the balance sheet part is obvious, right? That $879 million debt reduction since he started, that speaks volumes. It led to an 80% drop in interest expense year over year. Huge. And that financial flexibility directly feeds the second point: investing more in core stuff. Data center, LoRa, PerSe tech. These are now driving sales momentum, so the investment's paying off. Culturally, he emphasized customer intimacy, strong execution. Seems to be leading to better design wins. For year 2, the plan is to get more aggressive. Use that R&D money to, quote, outright lead the market. They're focused on high bandwidth, low power, low latency, low cost solutions. And they're keeping an eye out for small tuck-in acquisitions too, if the tech or customer fit is right. Moving from fixing things to really growing.
Okay, aggressive growth. Let's talk about where that's happening. Starting with the big one, data center. What's the story there?
Yeah, data center is really the engine right now. Net sales hit a record $52.2 million. That's up 92% year over year, 92%. It's mostly driven by record sales for their fiber edge products. These are optical chipsets, and it's being helped by newer things too, like copper edge, and this is a big one, 800G Linear Pluggable Optics, or LPO. What's driving all this? It's the hunger for data rates. 800 gig, 1.6 terabit, needed for AI compute and networking in those massive data centers. Semtech's right in the middle of that.
Okay, LPO. Linear Pluggable Optics. You said that's a big one. What exactly is it, and why is Semtech potentially well-positioned? They mentioned being the only compliant driver.
Right, LPO is super interesting. It's a different approach to optics. It removes the DSP, the digital signal processor, which saves power and reduces latency. Semtech's already got design wins for their TIAs, that's a key receiver component, in 400 gig and 800 gig LPO modules. And they're actively working with 3 major hyperscalers, 2 in the US, 1 in China, for their 800 gig LPO solution. They expect revenue from that to start ramping in Q4 of this fiscal year, so pretty soon. That claim about having the only compliant 800 gig LPO laser driver, if true, that's a significant edge. It might even mean more Semtech content per module compared to the old DSP way. They call it a double content opportunity. Plus, they're already pushing ahead on 1.6 terabit LPO, aiming to sample by year-end. Volume ramps potentially first half of 2026. Big potential shift.
Double content sounds good. You also brought up copper edge. How does that fit in with all this high-speed optics stuff?
Yeah, good question. It's complementary, not competitive, really. Copper edge is about active copper cables, ACCs. Think smart copper cables for short distances, like inside a rack or between racks in a data center. They're testing 800 gig and 1.6T versions with Hyperscalers now, the advantage. Good signal integrity for short runs, lower latency, and potentially up to 90% less power than using optics for those same short connections. So they expect initial demand for 800 gig ACCs in Q4, mostly for what they call scale-up applications. It fills a specific niche alongside FiberEdge and LPO.
Makes sense. Okay, shifting gears from the data center frenzy, what about high-end consumer? How are they doing there?
Doing pretty well, actually. Net sales are up 16% sequentially, 11% year over year. That fits with smartphone seasonality. Management believes they're gaining share. Why? Two main technologies. Their TVS protection diodes helps protect sensitive screens from static discharge and stuff. And their PerSe sensing tech. That's for human presence detection gestures. It's finding its way into more smartphones, laptops, smart glasses, Meta's Ray-Bans, and even cars now.
PerSe and Meta's glasses, interesting. Okay, last major segment, industrial, particularly LoRa and IoT systems. LoRa is their long-range, low-power tech, right? What's new there?
Exactly. Industrial overall was up 14% year over year. LoRa specifically, even with a small sequential dip, was up a strong 29% year over year. The big development is new dual-band capability. So LoRa can now run on 2.4 gigahertz and the usual ISM bands. That gives it more bandwidth, basically opening up new uses. Think things like the low-altitude economy, drone delivery, aerial surveying. These need that robust, long-range, low-power link that the new LoRa provides. Also, edge AI. They actually hit a record for end node shipments last quarter, and they've upped their quarterly LoRa revenue guidance now to $30-40 million. Their other IoT systems hardware did well too, up 24% year over year, driven by things like 5G RedCap, which is for simpler IoT devices, and NTN for satellite IoT. Plus, they got their XR60 5G router verified by Verizon Frontline, which is a nice win.
Okay, so momentum across several areas. Given all that, what's the guidance for Q3? What are they telling the street?
For Q3 FY26, they're projecting net sales between $261 million and $271 million. The midpoint there is $266 million. That midpoint represents about 12% year-over-year growth, so continued growth. Adjusted gross margin expect around 53%, similar to Q2, and adjusted diluted EPS between $41 and $47, midpoint $0.44. They expect sequential growth, again, in infrastructure, meaning data center, and also in high-end consumer, due to seasonality and those content gains we talked about. Industrial expected slightly up, with LoRa maybe flat to slightly up. Pretty steady outlook, really.
It really does sound like, as you said, discipline meeting momentum. They fixed the finances, now they're pushing growth.
Precisely. That's the narrative. Moving from repair mode to capitalizing on AI optics and IoT growth, cutting the debt was huge. It gave them the room to boost R&D by 20% sequentially, even while delivering good results. That positions them to chase that market leadership, especially in LPO.
So what should people be watching for? What are the key catalysts in the next, say, 6 months?
Okay, key things to watch. Q4 FY26 is when we expect that LPO revenue to really start showing up. That's the big proof point. Before that, the upcoming Q3 earnings call any updates on LPO purchase orders. That'll be critical. Also, more news on hyperscaler qualifications, module partner wins for LPO and ACC. That builds confidence. And keep an eye on LoRa channel data, especially heading into the holidays. Broader picture. Data center spending by hyperscalers, both US and China, looks strong for 26. That's a tailwind. And interestingly, Semtech stock has actually outperformed the SOXX Semiconductor ETF recently. Suggests the market is starting to buy into their specific story. Oh, and they'll be at some investor conferences in September. Might get more color there.
All right. That brings us to our This Is Not Financial Advice segment. Time to pitch an outrageous but plausible trade idea. What have you got for us?
Okay, let's do it. Considering Semtech's cleaned up balance sheet and that potential LPO inflection point, here's the idea. AI, optical ascension, go long SMTC, short SOXX, as a defined hedge. Right, the thinking is this. Semtech isn't just any semiconductor company anymore. They're positioning to be a critical supplier for AI optical interconnects. That's a high growth space. LPO ramps in Q4. They've got those 3 hyperscalers engaged, plus the 1.6T pipeline for FiberEdge and CopperEdge. We think this sets them up for outsized gains as AI data center spending keeps climbing, and the potential for double content with LPO versus the old way. We don't think the current stock price fully reflects that yet. So specific catalysts tied to LPO could drive SMTC higher, potentially much higher, than the broader semiconductor sector. So how would you treat it? Well, mechanically, you'd buy SMTC shares. You're betting on these specific catalysts, the LPO ramp, strong financials. We think news on LPO orders in the Q3 call could be a trigger, especially if that only compliant driver claim holds up. To hedge out the general market and semiconductor sector risk, you'd simultaneously short the SOXX ETF. The target. Aim for SMTC to outperform SOXX by maybe 20-30% by, say, Q1 of FY27. That's when LPO revenue should be more established and the 1.6T story clearer. Now, what's the risk? The main risk is simple: delay. LPO or ACC qualifications take longer, or hyperscalers adopt slower than hoped. That happens. But management sounds confident about those 3 hyperscalers, and they're accelerating the 1.6T R&D. That signals conviction. Plus, you've got the industrial and consumer businesses providing a bit of a safety net. It's really a focused bet on their execution in this very specific, very valuable part of the AI supply chain.
Okay, that definitely qualifies as food for thought. So, wrapping up our deep dive on Semtech's Q2 FY26, it seems pretty clear they've made huge strides financially and are really zeroing in on these big growth areas in data centers and IoT.
Yeah, the numbers look good, the debt's down, guidance is solid, and they have clear catalysts ahead, especially LPO. It's a constructive picture. Obviously, keep an eye on that Q3 earnings call for the next data points on LPO and customer progress. The question really becomes, how quickly does the market fully price in this shift they're making towards being a key AI infrastructure player?
We've covered a lot: LPO, copper edge, LoRa, the management strategy. What really stands out to you from this call? We hope this gives you a solid foundation for your own thinking and, of course, encourage your own research.
And just to reiterate, everything discussed here is purely for informational purposes. It is absolutely not financial advice. Always consult a qualified financial professional before making investment decisions.
Thank you for joining us on the Deep Dive. We'll be back soon with more earnings analysis.